Hello, I'm Puneet Wadhwa, and today we have Amish Shah, Head of India Research at BofA Securities with us on the show today. Hello, Amish, and welcome.
Thank you, Puneet. Pleasure to be here.
Do you think that the US Fed outcome and the other global factors will be the driving force for the markets rather than the budget proposals till the D-Day?
Yeah, Puneet. As we know that the Fed is already going through its meetings and they have set the course for bringing forward the rate hikes. This is critical because it moves the cost of equity valuation assumptions for a variety of firms. The easy liquidity of money obviously slows down. That to some extent impacts growth as well. So I think markets will react to that. This is an event that we had predicted for the year, but just about a month back, the expectations at that point in time were that the hike will start from June, which is now brought forward. So markets will have to adjust to that new normal. But I think to a large extent, this was now being anticipated for about a week or 10 days. And markets to a large extent have already adjusted. So incrementally, I don't expect too much of a big correction to the markets anymore.
Can the budget be a non-event for the markets then?
Budget to a large extent has already become a smaller part as compared to history going, and the reason for that obviously is that there are a variety of issues that are now being addressed outside of the budget. But I would not call it as a complete non-event, especially in this year, because as you know, this is the budget which is coming at a time where the government cannot work with higher fiscal deficit. There has to be some sort of fiscal consolidation because COVID-related issues are now broadly getting over. Along with the reduced fiscal deficit, there is also a clamor for demand stimulus, which the government has given in measured doses so far. So there is therefore a debate that if you cut the fiscal deficit and if you have to give the demand stimulus, is there money to continue doing capex, which is what the government intends to do.
So what kind of a fiscal deficit would the market be comfortable with?
We are expecting a 100 basis point contraction in fiscal deficit to go down from 6.8 to 5.8. That number, I would say, is in line to slight positive versus consensus expectations. Broadly, investors, basis our conversation, are expecting at least 50-60 basis points of fiscal deficit contraction. So 100 basis point will be a positive news.
Privatization, funds for public sector banks, capex push, all these are known factors. Where can one expect some surprise?
So demand stimulus, I think, is more of an ask right now, but it is not like a given that the government would be able to provide. We do think that the government may be able to provide around $20 billion of stimulus, $11 billion coming in the form of tax cuts, and $9 billion coming in the form of subsidies. But more than that, the other surprise or the positive that I would take along is we do think that government will continue to improve the transparency of the budget, and there is a possibility that the demand stimulus comes in the form of tax reforms, which is something that the government wants to do. When they came up with the second option of filing income taxes without deductions. If they work on those lines, that will definitely be considered as a positive, because any demand stimulus to subsidies is going to be considered more populist. But any demand stimulus through tax reforms achieves both the goals of giving a stimulus plus implementing reforms. So that if the government does, I think will be a big positive.
Okay, so another report from BofA Securities suggested that the budget measures may be populist in the backdrop of the upcoming state elections. Can you elaborate on what all is expected?
So I would say, Puneet, that if you recollect last fiscal year, while the government in the budget had not provided for too much of subsidies, but actually throughout the year, post-budget, the government kept on increasing support in the form of subsidy. Let me give you examples that On an average, the food subsidy per year is about 1.5 trillion rupees. But the government continued with the free food program for the entire 12 months of this fiscal. And they, on the back of that, doubled the food subsidy bill to 3 trillion rupees. Right. Same goes for fertilizers, that on the back of a record 2.5 to 3-fold increase in fertilizer prices, the government increased the fertilizer subsidy bill by about 600 billion rupees. And obviously, we all know that the government also cut the excise duty and the customs duty on fuel and edible oil, which was another 800 billion rupees. So all of this, in a way, is a demand stimulus, right? Because it goes on to increase the wallet or the disposable income that you have in the hands of the consumer. So there has been demand stimulus that has come up in some form, and a continuation of that. So while we do the numbers for next year, there is, in a way, now it feels that there is no need for free food program, but we are still conservatively budgeting that the government can continue with that scheme for another 5 months. And we are also conservatively assuming that fertilizer prices continue to remain high internationally, and the government will fully provide for that high prices as well. So that those two things particularly, along with continuing lower of excise duty on fuel, I think are the populist or the subsidy-driven measures.
Despite these demand push measures, so to say, the rural economy, the rural India continues to, be not on as strong a footing as it was, say, a year ago. So, despite this demand push, do you think that the demand will actually come through?
So, versus the expectations that we had built in, I think there is a need to readjust that, that downwards. So let's say if I were to look at consumer stocks, I think there is a need that earnings will get downgraded. But from an economic momentum perspective, if the government continues with these subsidies or the tax cuts that we are talking about right now, along with the capex push, I think that helps. Because if you think about, while it sounds like capex does not benefit the rural India, there are plenty of rural focused infrastructure schemes that the government works on, and that does benefit. In fact, I will go on to say that while let's say schemes like Manrega or Pradhan Mantri Awas Yojana, which gives affordable housing, while the government provides for that as a revenue expenditure, because it's actually it's in a way it's a revenue expenditure, but the end result of these spends leads to capital creation, right? Because if the government gives CLSs or credit linked subsidy scheme for PMAY housing, somebody's buying a house on the back of that, or Manrega spends leads to some rural infrastructure creating on the back of that. So I think that to some extent, even the capex is going to help recover or revive the rural economy over and above the obvious subsidy driven measures that we spoke about. So I think that the economy is doing quite well, and on the back of these measures that we are expecting, it will help revive the rural economy growth as well.
Okay. What are the 3 or 5 sectors, according to you, that will benefit most from the budget proposals?
So I think, given that we are talking about government balancing demand stimulus as well as supply stimulus, which is capex, I think purely from the budget, consumption, financials, industrials, these are the 3 sectors that benefit. But coming to the point that consumer stocks earnings expectations are reasonably high and needs to take a notch down, we think that the rally in consumer stocks may be difficult to sustain. So for the year as a whole, we are underweight on consumer stocks, but financials and industrials, I think, will be the key stocks that will benefit from the budget and even outside of the budget.
Okay. What can retail and foreign investors hope for?
So for retail investors, particularly, I think, if you're asking this from a stock market perspective, the government delivering a good balanced budget means that the markets continue to hold up well. The other way to look at it from a retail investor perspective is the tax breaks that we are talking about.
Right.
If that comes through, that obviously improves their disposable incomes. From an FII perspective, I would say to some extent the same things as well, that they want to keep they want to see the momentum of reforms continuing in India and the government not going overtly populist. So I think if the government does demand stimulus in a measured form and continues with the tax reform or transparency of the budget as we were discussing, and also give them some kind of a path towards fiscal consolidation, all of this will be seen as government wanting to be reformist, and that will be positive for the FII investors too.
Okay. So one last question. How should one approach the markets then? Stay right now or start nibbling in?
We definitely are in the camp of buy on dips kind of a view in this year. So let me put it this way, that this year there are plenty of events, and most of these events are negative or they are headwinds. So we already discussed the Fed rate hike, which is a headwind. Our house view is that crude by June will go up to $120 a barrel before it cools off and averages at $85 for throughout CY22. But first, it going to 120 is obviously a risk to the market. And while right now everybody is expecting BJP to win most of the local elections where they're already an incumbent, any negative surprise on that can be a risk to the market. So there are some of these risk factors through this year. And on the back of that, we do not rule out intermittent small corrections for the market. But our view or outlook for the markets for the whole year is bullish, and that is driven by three quick points. One, India in a relative context versus other emerging markets is going to stand out, both in terms of earnings growth as well as GDP growth. Second, we think that after a decade, there is a reversal of a trend where corporate earnings growth of India is going to outperform the nominal GDP growth of India, which is what investors will like. And number three, we think that this is a time where credit growth cycle, real estate capex cycle, and the overall capex cycle in together are all going to start accelerating. And generally, a combination of these three cycles coming together leads to very good economic and earnings growth momentum. So on the back of all these three things coming together, we think that India will continue to do well as markets. Our year-end Nifty target, as you would know, is 19,100, which is a reasonable upside from where we are today.
Thanks, Amish, for joining us today.
Pleasure. Thank you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.